Hi, Matt Batty here again from Complete Wealth. And first of all, thank you for everyone who's been commenting and sending us responses back to some of the videos we've been sending out recently. We really appreciate it. And that's kind of inspired this one. So we've had a few people ask a range of questions, and so we've tried and condense them down into some sort of basic topics. So this is a bit of a sort of a questions without notice scenario. We'll sort of see how it goes. But this is a summary of the sort of questions some people have been sort of asking, or at least alluding to in some of the comments we've been receiving. So I'm joined again by Christopher Sutherland from our systems team.
Okay.
So Christopher's going to be firing the questions at us, and we'll sort of see how we go.
All right. So the first one, can I lose all my money?
I assume this is in response to the market volatility that we're sort of seeing at the moment. So I guess like all great answers, it starts with a depends, right? So depends on what it is you're referring to. So if we're talking about someone who's invested in, say, one of our portfolios, one of our client portfolios, that's been constructed very specifically with a very detailed and specific philosophy in mind, or a very broad-based, well-diversified, let's take the market. Let's say we use the index as a default, right? So if we said, okay, well, the ASX 200, has gone down, I think peak to trough is almost sort of 40%, depending on where you kind of measure it from. But so if you think about what that means, it means the prices of mostly the largest companies, but the prices of companies have dropped, because that index is essentially the sum of, for each individual company's market capitalisation, and their individual capitalisation is simply the price multiplied by the number of shares issued. And the price is the last price that the shares were traded for. So what was actually sold for. So if you think about that from a mechanical point of view, someone might have, the last trade of yesterday may have been 1,000 shares in, say, CBA, for example. And so because 1,000 CBA shares were sold at, $60, whatever the price was, that sets the price. That's the close for the day, whatever the last trade was. And so that sets the price for all other shares. Now, there's about last I look, about between 1.7 and 1.8 billion CBA shares. And so whatever that last volume was sets the price for all of those other shares. So for you as a shareholder to go broke, what has to happen is the company itself has to, its liabilities have to exceed its assets. So it's got nothing to do with its share price. If it's got bills to pay and doesn't, like any small business, if it can't pay its bills, it now goes broke. And therefore it has to sell the assets to meet those creditors. So let's say CBA can't meet its creditors because it can't trade anymore. Home loans default and people can't. So CBA's gone broke. Then the shareholders don't get any money back until all of the notes holders and debt holders and all the higher ranking security holders in CBA get paid out, and then the shareholders. So they're always last. They have the highest risk, if you like. But CBA as a company, a trading entity, has to go broke for the shareholders to essentially be at risk. If CBA, the share price can go down to anything, right? But as long as CBA has money to trade, home loans and credit cards and deposits and all those sort of things, and continues to operate, then the price of CBA shares is irrelevant in terms of operation. It's a bit like saying my local cafe closed yesterday for 6 months. So it's going to have no turnover. What's the value of that company? Well, arguably, a company that's not trading is probably not worth anything. And therefore, if you sold it off and had the assets or whatever, sold off its coffee machine and whatever, then, it's probably not going to be worth very much. But if they come back in 6 months' time or a month's time, whatever, and they start trading and they suddenly they're profit again, then the company's worth, whatever that profit is kind of worth. So the fact that, at the moment the shares in that cafe are probably worth nothing because you don't know what it's going to be worth in the future, it doesn't mean that as an entity it's gone broke. It's able to meet it's got no bills to pay, or it's paid its bills up front, whatever. As long as it can continue as a going concern, it's fine. So if you then extrapolate that to the whole market, well then how does the whole market go broke? If I own the index, say the ASX 200, that's proportionately I own the top 200 companies. Now I don't own an even amount of each one. I own a lot more of the big ones and a lot less of the smaller ones, but I own a portion of all of them. So for me to go broke, all of those companies have to become insolvent and not have any assets left to pay shareholders after other creditors. So let's say that's possible. Let's say they're all heavily geared or whatever it is and they don't have any real assets. Now, people like BHP and Woodside and some of those companies probably almost certainly would, but so that's where you get into things like the book value of assets and those things. But let's assume that they don't. What's the likelihood that the biggest 200 companies in Australia all go broke on the same day? It's never happened, right? Mm. And if it did, Woolies is gone, Telstra's gone, all the banks are gone, BHP's gone, Rio's gone, they're all gone. Never happened before anywhere in the world. So it's our compliance people would say, I'm not allowed to say that that's not possible, but your super is the least of your concerns.
Right.
So my view is it's an event we don't even cater for. It's that beyond the realms of possibility. Now, could the profitability of all those companies be massively affected? Possibly. So we might say, well, this is an economic event. It's not just a market thing. It's an economic event. And so the market's dropped 40% for a reason. But if you were to say, well, the market was reasonably priced before that, and there's a reasonable argument to say that wasn't too bad, for that to be right, that pricing now to be right, what you'd have to be saying is the economy's taken a permanent 40% hit. That's really what the pricing is telling you. I think that's extremely unlikely. You know, maybe it's taken a 10% hit or 20% or whatever the long-term effect of that is. It might be almost zero in the long term. If we go back and we look at historical events, that's certainly the case. There's a hit and it does make an impact. It's not zero, but it's not 40. But in terms of can it go further in pricing-wise, it can do anything pricing-wise. But losing your money, that requires the entities themselves to go broke. And that's just all but not going to happen.
Right.
All right. So as long as we have a society, as long as we have companies trading between each other, then the recovery will come. The question is when and how long and those sort of things. That's a very different question. But in terms of going broke and losing all your money, not really.
Right. All right, next question. So we got my neighbour or my colleague, my co-worker, told me that the market's going to drop further next week. Explain to me how they might know what that's about. Probably right. So this gets into the whole concept that we talk about of what's foreseeable, what's predictable, and then ultimately what's actionable, and what's the risk of that action. So could I foresee the market dropping next week? Absolutely. Like there's never been a day in history where I couldn't foresee that. And I could give you great reasons. It's why when you look at the finance news at night or whatever, you'll see, you know, whatever talking head expert there is, there's always a reason why the market went up, down, sideways, whatever it is. There's some news today that did this. In fact, one of the things I encourage people to do is read newspapers or news reports a week old. So if you read the paper from a week ago and then see how much of that news is still relevant to you, it gives you a very different perspective on just how urgent and important that was. But if you think about that just from a mechanical point of view, right? So let's say that you know the market's going to crash on Wednesday, right? Well, the smart money gets out on Tuesday, doesn't it? Doesn't the smart money go, well, what am I waiting for? Don't ride it to the end, right? Let's just get out on Tuesday. Yep.
But the super smart money knows that, right? So Monday afternoon, it's out, right? But the inside money knows that the super smart money is getting out on Monday. So why are they taking the risk? So they got out on Friday, right? And then the hedge funds or whoever's in front of those people got out on Thursday. So everyone got out yesterday, in other words. And not only the get out scenario it's a really important thing to understand in markets. So if you look at a market, look at a share price, a trade, you know, this is again, I'll use CBA, was trading at say $60. That means someone sold it for $60, which also means someone bought it. So there's this idea of investors fled the market or people got out. No, shares traded hands, right? So if investors truly got out of the market, then there wasn't a trade, right? So investors,
no one's buying. Someone
bought it, right? So otherwise there wasn't a trade. Otherwise it'd be like there's no volume today. Now, the volume might have been whatever it was, and the share price moved to whatever the balance of buys and sells were. But if there was a price today of a stock, then there was a trade. And if there was a trade, then the same number of sellers was matched by the same number of buyers. So there's no such thing as getting out of the market. It's just who paid what price. It's a bit like saying, yeah, David Jones had a winter sale today where it was 70% off coats, right? And so, I don't know, coat people got out of the market today. It's like, no, I got a bargain on my winter coat. That's what happened.
Yeah. All right. So next one is, can my income protection help with COVID-19?
So that again, it depends. So if you're unable to, so most income protection policies, and as always, you need to check the definitions and policies. And if anyone's got any questions on that, definitely give us a call. But if you're able to work because you're sick or injured, normally is the definitions around income protection policies. If you're unable to work beyond your waiting period, then it really doesn't matter in most cases why you can't. It just matters that you can't. So if you unfortunately have contracted coronavirus and you're sick and therefore can't work, then yes, in most circumstances, your income protection policy would kick in and pay you whatever your benefit was. But if you've lost your job because you're a tradie or you're a cafe or your business has shut down and essentially you're unemployed, that's not what income protection policies are designed to do. That's not part of what they cover. It's a sick or it's I can't work because I'm somehow physically unable to work. Which some people find a little bit, sometimes even say unfair. But one of the important things to appreciate with income protection is it's not designed to be a living wage. It's not designed to look after people forever. It's designed as a safety net to get you back to work, so that you're not financially, destroyed if there's a period of 6 months or a year or a couple of years where you're unable to work because of a major illness or injury. And the other thing that's important is that, in fact, the regulator has just last year effectively sort of changed all the rules around income protection, because no insurance company makes money off income protection. They lose something like $1 billion a year collectively. So there's been some recent changes to policy. So it's really important, if you have an income protection policy, to make sure that you check, what these changes might mean for you, because there's been a change to the way income protection policies will work going forward. And this has been brought on by the regulator because insurance companies lose money on income protection, which means it's unsustainable, but it's an important safety net in the community. So yes, income protection will cover you if you're sick or injured, and this potentially includes the salary contingent sort of policies that are included in superannuation funds. But as always, you need to check with your actual policy as to the conditions. But generally speaking, if you're sick and you can't work, then yes. But if you've lost your job because of the economic implications of COVID, no, that's not what income protection does.
Right. What if my investment fund or my super fund specifically goes broke, whether it's AMP, Macquarie, etc.?
Okay, so again, let's sort of get to the specifics of this. So a super fund can't, well, generally speaking, a super fund can't go broke, because to go broke means your liabilities exceed your assets. Now, super funds, generally speaking, can't borrow. There's some exceptions to that, particularly with self-managed super funds and things like limited recourse borrowings. But in a general thing, if we took someone like Australian Super or Macquarie Super or whatever, then they're not really allowed to borrow, not in a substantial or meaningful long-term kind of way. So again, for a super fund to go broke, these are the fund itself, the assets of the fund that are there for the members, gets back to the same as a share market thing, right? So the underlying assets need to go broke. Now, that's possible where those assets themselves, their balance sheets, where their assets could exceed their liabilities. So again, we saw this, for example, in the GFC with things like property trusts. So where you'd have a trust and the trust had some gearing, and you get this situation where the property values got smashed basically. And so in some circumstances, the value of the properties dropped below the liabilities, and therefore the trusts were basically not worth anything. Or you had some credit funds where the loans weren't repaid and they sort of fell over. So in those situations, the underlying assets of those investments were zero. But in terms of a total fund, generally speaking, super funds must be diversified and well diversified. So even where funds, super funds, had assets like that, say through the GFC, for example, very few of those, particularly if they were large public funds or industry funds or whatever, any of those funds that had anything like those assets, they tended to represent a very, very small portion of the total. So it's a bit like I owned the whole index and a heap of companies went broke this year, but I didn't notice it because on aggregate they all went up. So yes, I owned some things technically that went broke, but the other ones made up for it. So similar thing in terms of super funds. So, if someone like Australian Super or a Macquarie fund or an AMP fund or whatever in their diversified fund or whatever had a little bit of private equity or a bit of, high yield or something, and when that happened, that tends to be a very small portion because they're well diversified. So for the whole fund to go broke, again, all the assets they own, all the bonds, all the property trusts, all of the infrastructure assets, all of the companies they own all around the world, they all have to go broke all at the same time.
Mm.
So again, nothing's impossible, but anything like that has ever happened ever before. So where you hear about, so-and-so lost a lot of money in their super fund or whatever, that's always they owned one of those assets in a big chunk.
Right.
And that went broke. And of course they did lose all that. They had a heap of money in property trusts or that heap of money in a particular type of investment that went broke. But a large, well-diversified, well-invested fund, no. The second thing is we need to separate the fund itself from the administrator. Okay, so for example, we take a company like AMP who've certainly been hammered a lot in the last couple of years with things like Banking Royal Commission and the outcomes of that. And AMP as a company, as a trading company, again, while it's relative, if you look at their current balance sheet and their economic and their sort of asset position, like it's foreseeable for any company, you could find ways to say, yeah, that this and this happened, they could go broke. But AMP at the moment are a trading company and they have some degree of solvency. So let's assume though, if something goes even more wrong for AMP and they can't trade anymore and they go broke as a company, as an entity, one of their assets is their ability to charge fees for running the super funds that they run. Okay. And so that is an asset that the administrator, when they come and sort of, administer the company that's gone broke, they would say, well, that's an asset. We can sell the right to charge that fee to someone else. So just as when AMP bought AXA, for example, what they really acquired in many respects is they acquired the right to charge the fees for the products that AXA had sold and was charging fees for. So now they're getting those fees for the old super funds that AXA had or the insurance policies or whatever. So that would be an asset. And so AMP, the liquidators of AMP would probably then sell that and say, they'd sell it to IOOF or someone else might buy it, right? And the price they got would determine the return that AMP shareholders got when they carved up AMP. But the people whose super was in AMP, that's kind of like it's a separate, it's held by a custodian. It's got nothing. It's not an asset of AMP. AMP can't dip into your super fund because they're struggling a bit this month. Right? They don't physically have access to it. That money's held by a custodian. They administer it, they sort of, shuffle the paperwork, if you like, but those assets aren't available to them. So again, when we've seen in the past, people losing all their super through some sort of fraud type activity, it's generally because it wasn't a major, APRA regulated, it was a self-managed super fund, something where, you didn't have APRA looking over their shoulder and doing regular sort of checks, and you didn't have that kind of layers of support with a custodian separate to the investments, investment managers and those sorts of things. So if AMP, the listed entity, went broke, again, its share price isn't necessary. It doesn't drive that. It might, if their share price is very, very low, they might not be able to raise capital they need if they needed to re-inject into business. But if they've got the capital they need and they're operating as a going concern, they're not going broke. And even if they did, the funds that they run, are unaffected by that. Now, if in your super fund in AMP you own AMP shares and AMP goes broke, then you'd lose that amount of money. But I doubt too many people would be in that position. Certainly none of our clients are in that position.
Right. Okay, so talk to me about the market crash and how that will affect your super and your pension.
Okay, so we'll separate super, so the accumulation part of super versus the pension phase of super. So let's take a very young person like yourself in his early 20s. So someone who's got, they say, 30 or more years till retirement. So let's look at the math of what's involved here, right? So at the moment, you're a net contributor to super. So every quarter, when your very generous employer pays your very generous super contribution to your super fund on your behalf, as legislated, that goes into your super fund. It essentially buys into whatever assets you've picked. And let's pretend you're 100% shares, right? So you're going directly into the market. So when that happens and you put, your, what do we pay, 40,000 a quarter or something as your super contribution,
right.
Something like that. So when that goes in, that buys units in something, right? So whatever the share price is, if the market's up at that point in time, you're going to buy a little bit less. And if the market's dropped, so at the moment, your super's buying into the market at 30 to 40% lower than it was a month ago.
Yep.
So if you think about that, the long-term profitability of the economy and the underlying shares or whatever, they are what they are. That's not really going to be material change. And we look at the long-term run of, overall profitability of the share market, it's basically the same as growth in the economy, right? So assuming that plays out okay, then you're going to get that trend. So you'd assume at the moment that it's a reasonable likelihood that we're below that trend, where the markets come. Now, are we just below it? Are we well below it? We can argue about that, but we're not above it, okay? Unless coronavirus is here to stay, we're not above it. So you're kind of buying in at a bit of a discount. So from that perspective, if you're an accumulator, you want the market to crash and stay there for 20 years because it just means the price is low and you're buying more units with every dollar that goes in. The last thing you want is the market charging ahead because you're just paying more for the units as you go in, right? So from your perspective, quite selfishly, you're like, crash, baby, crash. Let's get in there, stay down. Let me buy as many units as I can because I'm a net accumulator. Whereas if you're a seller of units, you want the reverse of that. You want a bubble. Right, you want prices to be really, really high and you want to be selling out of that. But again, even if you're a net seller of units, most sellers of units, they're not selling heaps of them, right? They're selling small portions at best. So then it depends. So let's move to the pension phase now, right? So I'd argue volatility and especially major volatility for accumulators is only a positive thing. All it does is give you more chance of buying below real intrinsic value.
Right.
Where if the market was just linearly charging up, then you'd be paying the right price the whole way up, but you'd never be getting a bargain.
Yes.
Okay, so crashes are a good thing to you and booms are bad because you're just paying more, right? The reverse of that is you're the retiree, right? So now you're at the point where you say, well, now I'm drawing on my super. And here's where a thing called sequencing risk is important. So sequencing risk basically says you might get an average return over a period of, let's say, 20 or 30 years, an average return of, say, 8%. But that doesn't come 8% one year and 8% the next and so on and so on and so on. You get that as an average return of plus 40 minus 25 in individual years. But the order in which those returns come matter. So if all your returns are great at the beginning and it blows your balance up and then the returns are bad at the end as you're running it down anyway, then it doesn't. That's a good thing to you. Whereas if the reverse is true, when you start with a big balance and all your returns are negative early on and you're drawing from those depressed balances disproportionately, right? Because if the price went up, for every bit you sold, you're selling a little bit less proportionally, whereas it goes down, you're selling a bit more proportionally. So sequencing is a big problem if you're selling units that are linked to the market price. If you're not, if it's coming from cash or if it's coming from distributions, the dividends or the rent or whatever from those assets, doesn't matter. Because the price of your CBA shares are just, let's say they're down by 30%, but the dividend's the same. And the dividend covers what you need to, what you're drawing, then you haven't sold any CBA shares, right? So the whole point of in your portfolio construction, the key aim here is that's what we really mean by how long you should be in investment. It's not a case of saying, okay, well, you should be in investment for, say, at least 5 to 7 years. Doesn't mean in 5 to 7 years you're going to sell it all and therefore you need the price to be high. It means you don't want to have to sell it within that time frame because the chances of it not being a reasonable return in 5 to 7 years is reasonable. There's a reasonable chance at any period in the share market between, say, any 7-year period, there's a reasonable chance that your return could be zero. right? Even slightly negative. There's very rarely that you get a negative return over 7 years, but it's still possible.
Right.
It's happened from time to time. But 10 years is extremely rare. It's really only a couple. 10, 15 years, none. 20 years, none, sort of thing. So that's what they mean by the time. And when we say that return, the dividend return through that period of time is very solid. So if I look at the volatility in return from the capital, the pricing, that can vary. I think the record's something like plus 85% in a year and about minus 55. So huge swings in terms of the price movements.
Right.
And if I look at what we call the standard deviation, so the average amount of volatility, it's like about 13.5%. So in other words, if the average is sort of 10, minus 3.5 to sort of 23.5, that sort of two standard deviation range, about 68% of returns fit inside that. And if you go one more deviation, 95% of returns fit inside that, right? So that spread covers, so 95% of returns fit somewhere between, let's call it, minus 17% and plus 30 to 37, right? In any sort of 1 year period. But if I look at dividends, the standard deviation, the average dividend is about 4.2% long term. And then if you add franking credits, that adds another 1 to 1.2. So let's call it 5.2, 5.4% average cash flow from the Australian share market. The annual standard deviation of that is 1%. Right. Mm. So in a really, really bad year, you're getting 3%. In a really, really good year, you're getting 7% dividend. So it's extremely rare for dividends to be below 3 across the entire market. Now, depends on what you own. You own a bunch of exploring mining companies, dividends be 0. They don't pay dividend.
Right.
If you own purely banks, your dividends might be 10% at the moment in particular. So they might be really, really high. But on average, the market's, that sort of 4 to 5.5% range is where it sort of sits. And it really doesn't change, even through recessions and through periods of substantial economic downturns. So if you're relying on that cash flow and you've got that sort of, that cash dam that we talk about, that stable pool, then as a retiree, yes, your balance has dropped, but your cash flow and the cash flow capacity of that asset pool really hasn't changed a lot, right? As long as this economic shock isn't, a 5 and 10 year, the economy really has crunched by 30 or 40%. And I think that's never happened before. It's extremely unlikely that this event, if there's going to be that event, it's unlikely that this is it.
Right. Okay. So moving on to the reaction, what's the impact of all this government money and how will it be paid for?
Well, that's the $1 trillion question, right? Yeah. So I think the first thing to really understand at the sort of micro level is that there's no such thing as government money, right? There's only our money that we give to government and the government redistributes some way. Now, they might redistribute all of it now. They might redistribute a percentage of it now and keep some for later. Or they might distribute more than we gave them and hence have to borrow the difference and then have to make that up in the future. So if a government gives us back more money than we've given them and therefore they go into debt, essentially, then we have to pay them back at some stage in the future. Or if that government is able to print its own currency, and not all governments can do this, but the Australian government certainly has essentially the access to do so, then they can print more money. But that's inflationary. In other words, basically, inflation is literally the amount of money there is in the system. So if there's more money than there is productivity in the economy, then the price of everything just reacts accordingly, right? And so that's not value. It's no difference to saying, we're putting these new notes out that have got an extra 0 on the end, but other than that, everything's the same. We're now paying 10 times as much for things. But the amount of stuff in the economy and the amount of cash, that proportion just changed. There was no growth in output. So the government spending all this money creates no value. That's not what they're doing it for. They're not saying, hey, because otherwise, if you think about that, if you think if printing money was the answer, then you just go to a third world country and you say, just print some money. just print some money and there's your economic freedom, right? So that doesn't work. So what they're trying to do with this is they're trying to say, hey, look, we're borrowing from future you, is what they're doing. And they're saying, and the reason we're doing that is because it's the velocity of money that drives an economy, right? It's that concept of one person's expenses and another person's income, and the velocity of that is really important. But if you remove the value creation from that and say, well, all we got to do is keep trading and things will be okay, which is essentially all a government can make you do. Here's money, trade stuff. If there's no value created, then all we're doing is just inflating the price again, right? So the reason they're doing it is they're saying, well, if you're not trading, there's no incentive to create the value, so you won't. So in the future, you'll have no more than today.
Yep.
And therefore, it's in all of our interests for that activity to continue. So there's an incentive for you to keep creating value, or for you to create value in new ways, because the way you were creating value is not there. We shut your shop, right? So you can't do that anymore, or you can't do it for a while. But if we don't give you access to any resources for you to find other ways to create value, then you just won't, or there'll be an extended period of time where you won't. And because of that, future you, as in all of us in this collective economy, we'll all have less output as a result. Therefore, we'll all have less wealth. And the trick is, if they could give us however many $1 billion now, it's a bit like borrowing. It's a bit like going to the bank and saying, give me $100,000 now because I can deploy it in a way that in the future I'll have more than 100. I'm making that bet.
Yep.
Now, if you don't, you're behind. But if you do and you turn that 100,000 into $1 million, then the bank's winning because they got paid, and you're winning because you've created that extra value. But if you don't create the value, then it's negative.
Yep.
That's what the government's doing. They're gearing, right? They're saying, we'll throw money at you because we're going to back you to create the value. They're not throwing money at the economy. They are for their interest in a political sense, but the government's not going to bail us out of this. The government isn't. They're measured technically as part of the economy because they draw on some of the capacity of that, right? But they don't really create things, right? It's the business community that creates things. So that's not to say the government doesn't get involved in business and do some of those things, but in a pure sense,
right.
Government's there to make sure we get along, right? Make sure no one attacks us, to make sure we can settle our disputes, to make sure we don't infringe on each other's rights. That's and they try and do that in a way that allows us to maximise our productivity. That's really, I think at least anyway, that's the essence of what a government's trying to do. And they're there in these circumstances. They're there to say, we need to save you from yourself a little bit because you might just not do stuff that you could otherwise do. Now, part of that might just be because you're like, oh, well, what's the point? And part of that might be, well, you just don't have any resources. So we'll borrow from future you some resources. So the answer is, that's a very long answer, I know, but the point to really understand that is that we will pay for it. The governments aren't paying for this, we will. And we'll pay for it through higher taxes or reduced services in the future, but in reality, that's how they'll describe it. We'll pay for it by being more productive. So the more we can spend now, the more we can keep that velocity going, the more that we can continue to create value between ourselves. That's how we pay for this stimulus, basically.
Right.
Right?
Very good. So I own some, blue chip shares. If they are high quality, how come they've dropped just as much or dropped as much as the market?
Yeah. Okay, so it's important to understand what happens when there's a market crash, right? And that gets back to that kind of what I was saying before about the buy and sell balance between things, because the vast majority of volume any given day on the market is driven by people who are just trading one thing for another. So they don't really care about. They care about the company and the prospects and the news, but they care about it from the expectation compared to what was already there, right? So if an analyst is looking at, say, BHP and its production numbers and how it's doing and what the markets and what the spot price for copper and whatever and coal or whatever, so they're looking at all that and they're saying, well, how does that play into their actual profitability and how does that compare to what I think the market's priced in, and is that going to be better or worse? And I'm going to buy and sell based on that. They don't really care about BHP's, what's the cost of their assets and, compared to their competitors, and what's their long-term run, and, what's their reserves and all those sort of things. They're factors in forming that opinion, but all they care about is the price going to go up and down when people realise something that I've just realised? That's what a trader's looking for, right? And so if they miss something and they're owning a bunch of like resource companies and the market starts to tumble, not a resource orientated thing, it's a virus, right? So a trader trades. Now, if you own things, just same as if you're Myer and David Jones put a sale on winter coats, right? And they say 50% off winter coats. And you don't do that. And you say, no, ours are still full price. No one's buying off you because they're coats. People don't fundamentally care too much. They just go, well, I don't care where I buy them from, so I'll just buy stuff. So I'll go and buy off David Jones. And so the same thing happens in the markets. Again, traders don't care whether it's coats, T-shirts, whatever, commodities versus, US shares versus emerging market shares versus oil futures. They're just things they can trade. And so they'll either quickly try to get out of everything so they're not exposed, because they're not selling their BHP shares for a higher price anytime soon. So you may as well get rid of them and buy something that you can do. In the same way that David Jones, when it gets to the end of winter, there's a sale on winter coats. Because it's like, well, we're not going to sell these anytime soon. So why have this capital sit there for all this time where we can't generate profits on it? So just get rid of it and replace it with something. Even if we don't make money, even if we lose a little bit of money on it, we can get that money back by trading something profitably over the next 6 months rather than hang on to it for next winter.
Yep.
So the same thing with traders. They do the same thing. So they're trading everything, trying to get in a position where they can now buy and sell profitably from whatever base they start. And because they're most of the volume in the market, they all load up on the sell side. And also they then start to see, well, how much can I get out of the other guy as well, right? So even if I want to go back in and buy, first of all, I don't want to buy into something that's falling because, again, I can't really sell it. I can maybe short sell to some degree, but I can't profit from the upside. So I want to wait till it's dropped a bit and then I'll start to. That's why you get these sort of dead cat bounces as well. And so it's important, I guess, from an investor's perspective that, to understand that while a blue chip share, it depends on valuation beforehand. So what we saw in markets coming up really for many, many years in recent times, and the one thing we were actually worried about in markets was this disconnect. There's two parts to it. One is there was a bunch of companies that have very high growth prospects where their prices have been bid up very, very high and the expectation these guys can make a lot of money. And so the valuations were very high. And there was also the very defensive side of the market where, because there was no money in bonds and anything safe, there's a lot of money going into companies that were considered to be bond-like. They're safe, they've got good profits. We'd rather make 3 or 4% dividend out of them than 0.2 out of a bond. Right. So a lot of money chased those and bid those prices up. So as always, if you bought something for more than it was worth, you lost that money when you bought it. The fact that you're only realising it now that markets are normalising a little bit, then that's a different story. But you really lost it when you bought it. But if it's a genuine blue chip, good, solid company that was reasonably priced, the reason it got sold off is because it was just something to sell. And traders sell everything that there is to sell. They don't really care about, Microsoft is a more profitable, better defensive company than Netflix. Right. They just sell the whole lot. Now, it might drop a little bit less. So, yes, you might have dropped as much as the market because often your blue chips are also, if you take Australia, what people might refer to as blue chips like banks and mining and whatever, they really are the index, right? The top 20 stocks is on half the index. So if the index dropped by, 20%, it's because the top 20 dropped by 20%. So but there'll be stocks that are down 70, 80%. If you look at, I saw like Afterpay, I noticed Afterpay went up 40% one day. And it was down, that much in many other days as well. So that if you look at the volatility, Afterpay, last I looked at it, had peaked at sort of $44 and got down to $9 and it was back up to 12 or 13 or whatever. Huge range of volatility. So a stock like that was very much based on its future earnings capability, way more volatile than a blue chip stock, someone like, BHP or CBA or something like that. That is a more predictable earnings-based company. But it also might be the fact that you might own that company in a sector that that the expectations changed, like banking stocks through the GFC. So again, it's a quality company. If you own good assets that are going to be okay in the long term, their price in any situation, especially these downturns, is largely irrelevant because even if they were discounted, or even if they hadn't dropped as much, whatever, to really make any advantage, you have to sell them and buy something that's materially better. So even at the moment, you say, well, you know, if I sell my whatever stock and buy whatever stock, I'm selling, you know, at a discount to buy at a discount, you know, unless there's a material difference. And there's rarely a huge difference between those during downturns. It's generally everything's pretty much down.
Right.
All right. So is that all we got?
That's all we got.
That's enough. So look, you know, we wanted to give a bit of detail in some of those answers. So hopefully you found that reasonably informative. As always, if you've got more, let us know. If you want us to drill into any of those a bit more specifically, or, you know, we can drill into some data, etc., we're happy to do that as well. But until next time, stay safe, and thanks for your support.